Are you correctly reporting your income from capital gain? Failing to declare some of your capital gains can land you in trouble. Today, you are going to find out if the money you have received from sale of properties, car, jewelry, mutual funds, shares, land, building are taxable. To find out, let's begin. Hey there, welcome back to the Sonia Dawar Show. I'm your host Sonia Dawar, Chartered Accountant and Business Finance Coach. And on this channel, we share with you all the tips, tools and resources you need to start and grow your profitable business, save lakhs of rupees on taxes and build your own wealth. When you finish watching this episode, you will learn about the most common mistakes people make while filing their income from capital gains. Well, capital gains are the profits you have earned when you sell your asset which has increased in value over time. This could be a car, a house, jewelry, mutual funds, shares, land, building, or even gold. A lot of capital gains that you might think are exempt from tax are actually taxable. But most people think they aren't taxable or they are not required to disclose the income they earned on sale of these capital assets and hence fail to report them. So here are the few examples of the common mistake most people make while declaring their income from capital gain in their ITR and how you can avoid them. So the first most common mistake that many people make while filing their ITR with income from capital gain is not filing information about long-term capital gain earned on sale of shares. When equity shares are sold after a year, the person selling those shares makes long-term capital gain, or in case of a loss, he makes long-term capital loss. If you buy and sell shares, you do need to disclose the long-term capital gain or loss that you have earned on selling those shares in your ITR. And if you make a long-term capital gain of more than 1 lakh rupees on sale of shares or mutual fund, you do need to pay tax on it at 10%. So many people think that if I have earned long-term capital gain below 1 lakh rupees, I don't have to pay tax on it and hence I'm not required to disclose any income, and which is completely wrong. If you have earned income or even a loss on any sale of shares, mutual funds, car, jewelry, house, land, building, you have to disclose the sale consideration. You can reduce your cost of purchase and you have to show the capital gain or loss in your ITR. My second mistake is also linked with the same thing, and that is not filing information about sale of jewelry, sale of car or sale of property in your ITR. For any capital asset other than shares or mutual fund, if you are holding those capital assets for more than a period of 3 years, the income that you earn on sale of those assets is considered as long-term capital gain, or the loss that you've considered on those assets is considered as long-term capital loss. But if you sell them within the 36 months of you buying those assets, this income will be considered as short-term capital gain and the loss will be considered as short-term capital loss. Short-term capital gain, whether on equity or any other capital asset, is taxed as per your normal slab rate, whereas long-term capital gain on equity which is listed is taxed at 10%, or long-term capital gain on any other capital asset is taxed at a flat rate of 20%. And just like when you sell shares and earn profit, many people consider that if I sell my car or my jewelry, then the amount that I have realized is so minuscule that I need not report it in my ITR. Whereas if you've received the money in your bank account, or even if you've received the money in any other form and you have sold your capital asset, you need to report the long-term or the short-term capital gain, or even if it is a loss, you will still need to report that loss in your ITR. With this, let's move on to the third most common mistake, and that is not disclosing capital gain on sale or transfer of mutual funds. you have to know one very important thing about mutual fund, that you may get capital gain on transfer of mutual fund even if you have not redeemed any of the mutual fund during the last financial year. This capital gain is dependent on the scheme in which you have invested in, and many a times due to various restructuring happening at the mutual fund level or the consolidations of various funds into another fund, there may be a scenario where the units that you are holding in your mutual fund have been transferred and will be now considered as a separate fund scheme, even though you have not redeemed the funds out of those mutual funds. It's very important before you file your income tax return to check if there is any capital gain from sale of mutual fund, if you have invested in any of these mutual funds. And how to do that, I have a separate video where you can download one consolidated statement for any mutual fund that you have invested in, or maybe two depending on who's your registrar and transfer agent. So there is this video where I have explained to you exactly how to download the statement for capital gain if you have invested in mutual funds. So don't forget to check out that video. The link of that video is given in the description, or it's also there in the cards above. With this, let's move on to the fourth most common mistake that many people make while filing their income from capital gain, and that is not making investments for claiming those exemptions and still going ahead and taking the benefit of those exemptions. If you want to save taxes on the capital gain that you have earned of selling various assets, there are various sections within the Income Tax Act which allows you to take the exemption if you provided you have invested the sale proceeds or the capital gain in certain type of asset, or if not, then you have deposited the money that you have received from the capital gain into a capital gain specific bank account with any scheduled bank. Now, many a times, many taxpayers, they don't go ahead and invest into those assets or invest the money into the capital gain account, but still go ahead and take those deductions, which is completely wrong, because Income Tax Department does get the information of where your investments are, or depositing the money within the scheduled bank for claiming those capital gain exemptions. So if you have not gone ahead and done those investments, don't take the benefit of exemptions and offer your money for taxation, because not doing that will be considered as not filing your return correctly and trying to take undue advantage of the provisions which are not really applicable to you. But if you want to do it right, it is possible to save taxes from capital gains by investing the money according to the section where you want to take your tax exemptions or your tax benefits from. And the fifth and the most important mistake that many people make while filing their income tax return with income from capital gain is not disclosing the loss figures. If you have made any loss on sale of shares or loss on sale of mutual fund, or even a loss on sale of any house property or any other capital asset. I have seen many cases where taxpayers have received notice from the Income Tax Department saying that you have concealed income by not disclosing the sale consideration that you have received on sale of those capital asset. Now, at the time of sending such notices, Income Tax Department does not consider the price or the cost that you have paid for purchasing those shares. So in the eyes of income tax, it is considered as you earned an income and you have not disclosed that income in your ITR. When you receive the income on sale of those capital assets, do disclose those income, do take the benefit of taking the index cost of purchase, and if there is a loss, do disclose those loss in your ITR. Don't shy away that by taking that step you might have to pull out more documents, or you might have to pay some higher charges to your tax consultant or your chartered accountant, because you will have to provide more information on your ITR. Take these steps at the time of filing your ITR so that you can rest assured that you can stay without any notice in the future when you are not really expecting them. Officials from Income Tax Department already have access to a lot of information that you don't even about. So failing to declare your income from capital gain is going to land you only in trouble, not anybody else. So make sure that you report all of your income from capital gains correctly in your ITR, take benefit of the exemptions and use legal ways to save money on taxes instead. If you like the value that we've shared with you in today's video, don't forget to hit the like button. I'm expecting at least 1,000 likes on this video. And while you are at it, do subscribe to our channel if you haven't already and hit the bell icon so that you will be notified of all the future content that is coming your way. And after you finish watching this video, don't forget to check our other videos where we have covered all the mistakes that you need to avoid, whether if you are earning income from salary or income from house property, income from business, general and most common mistakes while filing ITR, and mistakes from filing income from other sources. With this, I will see you in another video. Bye for now.